So is the latest surging tech stock, a hidden gem offering this massive AI opportunity, or is it just a classic retail value trap waiting to drop?
Right. That's the million-dollar question today.
Exactly. Welcome to the deep dive, everyone. Before we get started, please make sure to like the video, subscribe to our YouTube channel, and this is mandatory. Leave your thoughts and feedback in the comments section down below. We want to hear from you.
We really do. And just as a quick reminder, this conversation is entirely for educational and entertainment purposes, right? This is absolutely not financial advice.
Definitely not financial advice. So here's the mission for today. We are going to look under the hood of Cohu Inc. Ticker is COHU, and we're sitting here in mid-April 2026, and we have this massive stack of data to get
Oh,
through.
yeah. Real-time quotes, financials, technicals, insider flows, everything.
Right, the whole nine yards. And our goal is to decode all these mixed signals surrounding this $1.75 billion semiconductor testing company, because the signals are definitely mixed.
Right. They are completely fractured. I mean, the charts say one thing, the balance sheet says another.
Yeah, so before we dig into the fundamental health of the company, we really need to establish what's going on with the stock's price action right now. Like, why is everyone talking about Cohu all of a sudden?
Well, it's the momentum. It's just impossible to ignore.
Right, because the stock is currently trading at $37.34, which is hovering incredibly close to its 52-week high of $37.93.
And, keep in mind, it climbed all the way up there from a low of $13.55.
From $13.55. That is just a massive run. And the volume is surging too. We're looking at like 1.09 million shares trading hands.
Which is huge compared to their 65-day average. That's roughly 786,000 shares.
Yeah, so it's a huge spike. And on top of that, the technical indicators are just screaming. We've got a golden cross. That's when the 50-day moving average crosses above the 200-day moving average for those keeping track at home.
Right, a classic bullish signal.
Exactly. And the MACD is sitting at this super bullish 1.18 ACR, indicating this accelerating upward trend. And there is a big but. Here the warning sign is flashing.
The RSI.
Yeah, the 14-day RSI is at 76.97. Okay, let's unpack this, because I like to think of it like a sports car that is just redlining.
That's a good way to put it.
Right, like it's going incredibly fast with the golden cross and the high volume, but the engine might be overheating. An RSI over 70 means it's heavily overbought. So does an RSI this high practically guarantee a short-term pullback, or can momentum just defy gravity for a while?
Well, what's fascinating here is the actual mechanics of technical momentum versus overextension. You see, an RSI of almost 77 doesn't mean the stock drops to zero tomorrow, but it means the rubber band is stretched incredibly tight.
It's bound to snap back.
Exactly.
Yeah.
And the danger is that retail traders, everyday people, they often get caught buying at the absolute top of this momentum wave. They see the green candles and jump in right before the big institutional players take their profits and force a consolidation phase.
Oh, wow. Yeah, so they end up holding the bag.
Right. Gravity always catches up.
So since the technicals show a stock that is just running super hot, let's pivot to the underlying financials. Let's see if the actual money supports the optimism on the chart.
Let's follow the money.
Let's do it. So breaking down the fiscal year 2025 income statement, total revenue was $453 million, but they had a net loss of $74.3 million.
Right. A pretty significant loss.
Yeah, $74 million is no joke. But then there's this weird contrast when you look at the cash flow on the balance sheet. Because despite that massive net loss, they actually have positive cash from operations. Like $31.7 million in positive cash flow.
Yeah, it's a stark contrast.
And they have a massive total cash pile of $484 million. Now, a chunk of that is bolstered by $287.5 million in notes, but their debt-to-equity ratio is still super manageable. It's only 42.12%.
Which is quite healthy for a capital-intensive tech company.
Okay, so wait. How can a company lose over $70 million in a year but still generate positive cash flow from operations? Is this like a household that runs a monthly deficit on their credit cards but somehow still puts cash into their savings account every week?
That's actually a great analogy. It comes down to the difference between GAAP net losses, the official accounting rules, and actual literal cash moving in and out of the business.
Oh, because of non-cash expenses.
Exactly. Things like depreciation on their massive semiconductor testing machines or stock-based compensation. On paper, it looks like a $74 million loss to the IRS. but operationally, they are actually putting $31.7 million of real cash in the bank.
Okay, that makes sense. So the core business is actually generating cash. But then let's look at who is buying and selling, because this is where it gets really murky.
Oh, the insider flows.
Yeah, so Insider Senior Vice President Christopher Borson recently sold shares. In fact, insiders have sold about $488,000 worth of stock in the last 24 months. They say it's for diversification, but still, they're selling.
Right, which never looks great when the stock is at a high.
No, it doesn't. But conversely, institutional ownership is massive. It's sitting at 94.67%.
That is a huge chunk of the float locked up by institutions.
But here's the conflict. There are 171 institutional buyers in the last quarter versus only 93 institutional sellers. So way more buyers than sellers, right?
Yeah, it's bullish on the surface.
Right, on the surface. Yet, the net shares held by institutions actually decreased by 7.37% last quarter. How is that possible?
Well, you have to synthesize the institutional behavior here. Having high institutional ownership is a double-edged sword. It provides a lot of stability, but there's a massive risk of a mass exodus.
So what's happening with the math, though? More buyers, but fewer shares held.
It means 171 buyers are smaller funds taking little starter positions, dipping their toes in. But those 93 sellers, they are massive asset managers dumping huge, heavy blocks of shares. So the transaction count looks like people are buying, but the actual share volume is flowing out the door.
Wow. Okay, so the big money is quietly sneaking out the back, while retail and smaller funds are walking through the front door.
Exactly.
Okay, well, this tension between the surging stock price and this really mixed financial reality, it leads directly into Wall Street's biggest debate right now. Is the stock a value trap, or is it an undervalued AI darling?
That is the narrative tug-of-war happening right now.
So let's unpack the analyst ratings, because this is wild. The consensus rating on Wall Street is a strong buy. They have 6 buy or strong buy rating, 0 holds, 0 sells.
They love it.
They absolutely love it. But here's where it gets really interesting. There's a glaring mathematical contradiction here. The average price target from these exact same analysts is $34.
Right.
Which is lower than the current trading price of $37.34. I mean, the high target is $41, but the low is $26. Have you ever seen Wall Street aggressively tell you to buy something like strong buy, while simultaneously predicting the price will literally go down?
It's hilarious, honestly. But it happens when analysts upgrade the story of a stock before they update their actual mathematical models.
So the story is AI, but the math doesn't add up.
Exactly. When you look at intrinsic discounted cash flow models, DCF models, they say the stock is anywhere from 25% to 56% overvalued right now.
Wait, up to 56% overvalued?
Yeah, based purely on the cash they are projected to generate. But the AI narrative argues it's deeply undervalued because of its future potential in testing AI chips. The analysts want their clients in on the AI boom, so they slap a buy on it, even if their spreadsheets haven't caught up to the $37 price tag yet.
Okay, that explains why the short interest is rising so fast.
Oh, absolutely.
Yeah, short interest is currently sitting at 8% of the float. That's about 3.6 million shares betting against the company, and that number just jumped 13.3% recently. The bears are clearly looking at that $34 price target and shorting it.
But that rising short interest could actually act as rocket fuel.
How so? A short squeeze.
Exactly. If bullish news hits, say, a massive AI contract the stock spikes, suddenly all those short sellers get squeezed. They have to buy shares at market price to cover their losing bets, which drives the price even higher, totally detaching it from fundamentals.
Wow. It's like playing with dynamite. Okay, so with this valuation debate established, let's systematically lay out the fundamental best case and worst case scenarios. Let's do the ultimate bull versus bear showdown so you, listening right now, can weigh the actual business risks.
Let's get into the trenches.
All right, starting with the bull case, the AI growth play. So in April 2026, Cohu actually secured $30 million in real orders for their Eclipse HPC platform.
Real revenue, not just hype.
Right. And they are expanding into high bandwidth memory, or HBM, and AI data center testing. Plus, their test cell utilization has climbed to 76%, which apparently signals a broader semiconductor recovery.
It does. 76% is that magic threshold where semiconductor fabs have to start ordering new equipment because their current machines are maxed out.
Okay, so that's the bull case. Great AI future. But the bear case, the fundamental play, is pretty brutal. Q4 2025 was a massive EPS miss. They lost $90.15 per share when everyone expected a positive 8.02
A
cents.
huge miss.
Yeah, huge. And the reason? There's this massive cyclical weakness in the automotive and industrial sectors that is just dragging them down. And furthermore, their PE ratio is sitting around 70x. That is astronomically higher than their 5-year historical median of just 18x.
70x is a very steep premium to pay.
Right. So you're essentially paying a premium 70x multiple for the promise of AI data center growth tomorrow while carrying all this heavy baggage of lagging automotive chips today.
If we connect this to the bigger picture, this is exactly why retail traders so often get trapped in these scenarios.
They buy the hype.
Precisely.
Right.
They buy the flashy AI headline, the $30 million Eclipse order, and they completely ignore the boring but critical cyclical automotive weakness that currently pays the bills for the company. They're buying a 70x multiple on an industrial cyclical stock pretending to be an AI pure-play software company.
Oh man, that is a dangerous game to play. So bringing all these technical, financial, and narrative threads together, let's form a concrete timeline of what people should watch for next.
The short-term versus long-term outlook.
Exactly. Short term, we have to reiterate the downside risk here. There is a high likelihood of consolidation just because of that overbought RSI and the stock trading above its average Wall Street price targets.
The technicals demand a cool down.
Yeah, it has to cool off. But
Yeah.
from a long-term perspective, you point to the 2026 recovery narrative. Analysts actually expect EPS to swing positive to $0.62 this year as those AI infrastructure orders finally hit the bottom line.
Right, the automotive drag fades and the AI revenue takes over.
And the ultimate catalyst for all of this, circle April 30th, 2026 on your calendar. That is a Q1 earnings day. They have a sales guidance of $122 million plus or minus $7 million.
That earnings report is going to be the absolute moment of truth.
So, what does this all mean? Look, the short-term chart looks beautifully euphoric, but the underlying fundamentals demand some real patience. Remember to like this video, subscribe to the channel, and please leave a comment with your own take on the stock. Are you buying the AI hype or waiting for a pullback?
Yeah, we read all the comments, so let us know.
We really do. And we want to leave you with a final, slightly provocative thought to ponder. When a stock is riding an AI hype wave like this, but clearly struggling with fundamental legacy cycles, are investors actually buying the reality of the company as it exists today, or are they just overpaying for a lottery ticket to tomorrow's tech revolution?
Something to think about.
Definitely. We'll see you in the next deep dive.